Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Well, let's start with a major shift from the Federal Reserve.
Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
Well, as you just saw, Fed Chair Jerome Powell has signaled a significant pivot in the Federal Reserve's approach, acknowledging that the time has come to adjust policy. But with inflation still above target, we have public debt soaring and a recent revision revealing that 818,000 jobs were overestimated. Can the Fed truly afford to ease off the gas? And what does this mean for the job market, which Powell emphasized the Fed won't let slip any further? Well, to help us break it all down, we're joined by Joseph Wang. He's a former senior trader on the Federal Reserve's open market trading desk, and he's also the author behind FedGuy.com, which I love. Joseph has an insider perspective on the Fed's operations. Welcome to Kitco, Joseph. Great to have you.
Thanks for having me. It's a pleasure to be here.
So you just heard off the top, Joseph. I mean, there's lots to get to today. Obviously, Powell's speech at Jackson Hole was highly anticipated. And as expected, he confirmed a dovish pivot by signaling that it's time to come into some rate cuts. Of course, he didn't say how many. You've mentioned that the market has already been anticipating this, and we kind of always see that market running. Given that inflation is still above the target of 2% and core inflation remains stubbornly high, can the Fed afford to shift its focus away at this point? Is there anything that surprised you from today?
Well, first of all, I think it was a good speech and a little bit dramatic too. The time has come, so good for him. But from the Fed's perspective, I think it makes a lot of sense. Now, let's put ourselves in the shoes of the Fed. They have two mandates: full employment and price stability. Over the past couple of years, now inflation has been much too high. And at the same time, we had a pretty good labor market with the unemployment rate at multi-decade lows. Now, fast forward today, things are very different. Now, the labor market, the Fed thinks it's still okay. But to be clear, it's been weakening pretty notably over the past few months, with the unemployment rate jumping up to 4.3% last month. So the labor market is weakening. That's one of the Fed's mandates. Now, on the other mandate, inflation, now you're totally correct. Inflation continues to be above 2%. It's too high. But the direction of travel, though, is very clearly towards 2%. Now, the measure of the inflation the Fed likes, it's not PPI or CPI, it's a measure called PCE. Now, PCE inflation is about 2.7% year over year. So that's above 2%, but we can see that it's only a little bit above 2%. And what Chair Powell was telling us today is that looking at the direction of travel, he feels comfortable that inflation is going to get to 2%, and he's becoming more worried about the labor market. He does not want it to weaken anymore. And because of that, he's going to cut rates. Now, one more thing that I would add is that the level of rates is really high. Now, the short-term interest rates about 5.5%. That's multi-decade level highs. And so, the Fed feels like they're really restrictive, and so they have a little bit of room to adjust lower.
Yeah, we talk to people all the time. Some analysts say, okay, we've started the year with 5-6 rate cuts priced into the markets. Of course, we've waited this long to get here. We know that some of the people behind the Fed, several FOMC members, were already ready to cut back in July. Did they wait too long here, or are they going too fast?
So, as you correctly mentioned, the market really likes rate cuts, and over the past few months, we've seen the market kind of get ahead of itself. In January, the market was pricing in as many as 7 cuts this year, and so far we've had 0. Now, the market is very bad at predicting what the Fed will do, so I wouldn't pay too much attention to what the market is thinking now. Now, whether or not we are too late, I think there's a good chance the Fed may be a bit behind. I think with the labor market weakening so clearly over the past few months and inflation coming down so clearly, they could have cut last month. Now, that being said, though, the market has been pricing in more rate cuts. So in a sense, if you are going out, for example, to buy a house, get a mortgage, you're already seeing your mortgage rates come down. So I think that mitigates a little bit about the slowness of the Fed. So I'm not too concerned right now. What I am more concerned, though, going forward is not what the Fed will do, but really what happens for the November election. I think that's going to have a much bigger impact on the economy and markets. The Fed, they've already showed their hand. It's going to be steady rate cuts from here on.
Yeah, before we get into the election, because of course that's coming up, we have so many things that the Fed is trying to pivot towards and really stay clear, as they're obviously not supposed to be political. But, the recent job revision showed 818,000 jobs were overestimated by the Fed, and it's certainly overestimated, raise some eyebrows, to say the least, Joseph, as I know that you know. How does this new data change your outlook on the labor market? Should there be bigger concern to the Fed and the markets following today's speech?
So one thing that I would note is that the Fed officials have already been suspecting that the labor market data could be overstated. Right. So we got their minutes earlier this week, and it noted that many Fed officials thought that the employment data probably might be a bit overstated. So that's something they suspected. And many commentators have noted this as well. Now, I don't think it has too much of an impact on their assessment of the economy, though. One, because they already suspected it. Two, the labor market is always noisy. Any data is always noisy, especially, though, right now that we have so much changes that are happening in the labor market. For example, we have tremendous amounts of migration, a lot of people coming into the United States. We don't really know how many. And of course, changes in the structure where a lot of people are working in the quote unquote gig economy, driving Uber and so forth. So it's a lot more difficult for people to have a grasp of what's happening in the labor market now. Mm-hmm. So I think it is a note of caution, but I don't think it changes their mind too much.
Yeah, it's funny. I mean, he wasn't really going around giving himself a pat on the back, but you could be saying, we were wrong, but so was everyone else. It kind of sounded like that. And it almost seemed as though during the speech today that we kept hearing this word unprecedented, and that's because of the pandemic. So, I mean, they're going into this already with not really any historical figures coming about. What could have been learned from this time around?
Well, you're totally right that the Fed kind of, first of all, they acknowledged that they thought inflation was transitory, right, and they were totally wrong. But they said that everyone else was wrong too. So maybe that's not too bad. They do think that they had an impact in calming inflation, but they phrase it in the form of keeping inflation expectations stable. So Chair Powell was on stage saying that, we kept inflation expectations stable because everyone has confidence in what we're going to do, and that contributed to lowering inflation. But I would also note, though, that there are surveys asking the American public what they think about the Fed, and most people respond, what is the Fed? So it's kind of hard to see how the Fed actually kept inflation expectations stable.
Yeah, I can see that. Sorry, Joseph. You also mentioned that the Fed might be out of the picture for the next few months, obviously, with the focus shifting to the November elections. Talk to me a little bit about their actions here. I mean, Jerome Powell's really been careful this year, it seems like, to try and remain unpolitical. Could there be a risk of, any of this being politically motivated, or at least that from a perspective of people seeing here being this close to the election?
Now, the Fed is not supposed to be politically motivated, but let's be clear, the Fed is comprised of people, and people have their own beliefs and preferences. So the Fed definitely is political, and they're political in a couple ways. Now, some might think maybe they're trying to throw the election to one party or not. I tend to think that's less the case, but to be totally clear, now, former president of the New York Fed, Bill Dudley, wrote an op-ed in Bloomberg a few years ago suggesting that the Fed, maybe they should conduct monetary policy in a way to sway the election against Trump. And if you're president of the New York Fed, you're the third most important person in the entire Federal Reserve System. So we know at least there were people at the Fed at the highest level who were running things from a political angle. So maybe that's still there. But I think a bigger way that politics in fact impacts the Fed is simply how they weigh that balance between full employment and price stability. Now, just generalizing here, but if you are a Democrat, you tend to value low unemployment more than low inflation. And so you tend to be more dovish. When I look at the composition of the FOMC, I notice that President Biden has had the opportunity to make a lot of appointments to the FOMC. These people, when I look at their backgrounds, don't really have very good backgrounds in macroeconomics, but tend to have very deep backgrounds in labor economics. So that tells me that this is going to be a Fed that tries to weigh, that will weigh unemployment more than inflation, and that argues for more cuts.
Yeah.
So I think that's how that.
How's that going to go? I mean, if the election results lead to significant changes in fiscal policy, how might that interact with the Fed's monetary policy decisions in the future then?
A lot of that is just going to depend on who actually becomes Fed chair going forward. I think we're heading into a world where the elected government is probably going to have more power over monetary policy than the past regime where we had more of an independent Fed. Now, one way you can see this is what's happening with how the US government has been issuing Treasury securities. Now, there's been a lot of studies and a lot of news stories covering how the US Treasury has issued a lot more short-dated treasuries than longer-dated treasuries over the past year. And that has led to some degree, an easing of financial conditions. Now, that's the executive, that's the elected part of the government having more influence on financial conditions. Now, I think that's usually how we could begin. Ultimately, though, I can envision a world where whoever gets picked to be Fed chair next time would be more obedient to the political class, to whoever is in the White House. So I think that's the direction that we're heading towards right now. And so I would expect future monetary policy to be more cooperative with the rest of the government.
Yeah, interesting. Okay, so a little bit more cooperation. And I know that you wrote a piece on Kamala Harris's fiscal plan going forward, or lack thereof. But talk to me a little bit without getting too political here. I mean, if Kamala gets in there or if Trump gets in there, I mean, is there one candidate that's the Fed's more excited to position at this point from your perspective?
Well, let's be clear. The Fed doesn't like President Trump. And I can understand that. Now, remember, during Trump's first term, he would go on Twitter and he would suggest that maybe Chair Powell is public enemy number one, right? So so obviously, I would think that the Fed probably is not too happy with President Trump. Now, that being said, though, President Trump has been more astute in calling monetary policy than the Fed. I remember in 2018 when President Trump was calling for lower interest rates and Chair Powell was hiking, they had different views on monetary policy. At the end of the day, Chair Powell realized that he was wrong. The markets were tanking. He did a 180 and began cutting aggressively in 2019. So I think the Fed strongly would prefer, let's say, a President Harris administration, simply because, honestly, if you look at public donation data, about 90% of all the people who work at the Fed donate to the Democratic Party. Right. The Fed is very much more of an organization that leads Democratic, and so they would, I think, very clearly prefer President Harris.
Yeah, it's interesting. Speaking of which, though, in your latest little op-ed, you talked a little bit about her policy. Would President Harris, or potential incumbent President Harris, would that be something that would be good for the U.S. economy here?
So far, President Harris Vice President Harris, presidential candidate Harris, has not been very open about her plans for her policies for her first term. What we've heard so far, though, are things that she's done in the past when she was running for California senator, and her recent speech she gave last week. And from my best read is that they're not very good policies for the economy. Now, President Harris wants to raise the corporate income tax, wants to raise taxes on higher income people, potentially tax unrealized gains, and suggested that she may be open to price controls, at least when it comes to groceries. Now, all these policies are not good for the economy. Now, when you raise taxes on corporations, now it doesn't take a genius to think that, maybe corporations, people might not be motivated to work as much as they used to. After all, if you have to give more of what you earn to someone else, maybe you don't want to do that venture that you were going to do. Maybe you don't want to put in those extra hours. When it comes to price controls, that's really surprising because price controls have been tried out across the world and across time. Even as early as Roman times, you'd have Roman emperors unhappy with inflation. Well, they just said that, you can't raise prices past this level. If you do, it's capital punishment for you. And that didn't work in Roman times. It didn't work in the 1970s when President Nixon tried. It did not work in Venezuela. It never works. What happens when you limit how much prices businesses can charge is that they stop producing, and you end up with shortages, and that drives prices up. And because businesses don't produce as much, it also drives up unemployment. So what you get is reliably stagflation, where the prices of things you want to buy continue to go up, but you can't get a job. So President Harris's policies, Vice President Harris's policies are honestly shockingly awful when it comes to the economy, and I suspect the markets won't like them as either. Although looking at market pricing, it doesn't seem like the market is too concerned about this at the moment.
Mm-hmm. Well, as you mentioned, we're just sitting here waiting for November to see what happens with it. I mean, we've certainly seen some of those policies that you mentioned on that almost socialist agenda be put up in place into places like Canada, and it hasn't been in their favor, that's for certain. Okay, no one mentioned debt. And obviously, we got the largest deficit in the U.S. history. I know it's not necessarily the Fed's place to comment on deficit, but, with the current economic challenges, we got this high inflation, public debt, and then this potentially weakening labor market. Where are we here? I mean, how should we be positioning ourselves as investors?
So I view tremendous fiscal deficits as actually positive for financial assets. The way that I would think about this is, well, when you are having a large deficit, you're basically buying goods and services by printing treasuries, which is basically dollars that pays interest. So basically, it's an inflationary move that would weaken the dollar and put upward pressure on financial assets. So if you are an owner of financial assets, big deficits are good for you. And we kind of see that happening over the past couple of years, right? Tremendous fiscal deficits, financial assets, homes, real estate, all go to the moon. There is a concern that as the deficit continues to grow, maybe that makes the market less stable. Maybe it's more difficult to find marginal buyers of U.S. Treasuries. But I don't really worry about that. The thing is, at the end of the day, the policymakers have a lot of tools to make sure that the markets continue to function. They could tweak regulations to encourage banks to buy, or at the end of the day, they can do as they did in March 2020 and just have the Fed buy it all. Now, if you recall, back in 2020, we had tremendous disorder in the treasury markets, and the Fed basically acted as the market maker of last resort and bought trillions in treasuries, and the problem went away. So I wouldn't worry about market disruption or anything from large debt. I think what that means really to me is that when it comes to the possibility of the probability distribution of asset prices, it's right tilted. There's a lot of upside risk to financial assets as long as we have a tremendous fiscal deficit.
Okay, so with Jerome Powell, I guess in a moment saying, okay, we kind of screwed up on this place, but you did too. With that being said, we look forward. Bring it out on the macro for us, Joseph. I mean, what's the worst case scenario and what's the best case scenario playing forward with today's dovish turn from the Fed?
Well, the best thing that could happen is that the Fed pivots, rates come down, and stimulates the economy, and we go towards a soft landing. Right now, actually, the data that we've had the past few months suggests that we still are in soft landing territory. Remember, GDP continues to be strong, above trend. Unemployment rate is rising, but still historically low. So there is a good chance that we could continue to go towards a soft landing going forward. Now, the bad scenario, I think, really has less to do with the Fed, but more to do with the political conditions. Now, when I think about economic growth, it's ultimately about people going out, building businesses, working hard. And in order for a business, say, to have plans to expand or for a worker to make that big purchase, they have to have confidence in the future. The worker wants to feel secure that they have their job so they can go and take out a mortgage and buy a house. The business has to feel secure that they know what their tax rates will be and that they have future demand for their products and services. A lot of that is kind of intangible. And I think that because the two candidates going right now have such different visions of the world, I can see businesses and consumers basically being on pause for a couple of months until we get into November, until they have more clarity as to how the world looks. And that could lead to a soft spot. And if we have, let's say, a less business-friendly candidate win, I think that could have a big impact on business confidence, consumer confidence, and that could easily throw us into a recession. So I think that's the downside scenario for me. Everything, to me, depends upon what happens in November.
Yeah, well said. And those two candidates still not discussing debt a whole ton. Always surprises me. Joseph Wang, the man behind FedGuide.com. Hey, thanks for this, Joseph. Some great insights. We really appreciate your time today.
My pleasure. Thanks for having me.
Thank you. I'm Jeremy Szafron for all of us here on Kitco News. Thank you for watching. Don't forget to hit that subscribe button to stay in the loop, and we'll see you next time.